Hi, I have friends in the Bay Area in California who invest in early stage venture capital, also known as VC. They often mention Don Valentine as a god. Who was he? Don Valentine was the premier venture capitalist of a former generation who had invested in Apple, Cisco, Oracle, Electronic Arts at the very beginning. Obviously, he died a very rich man. He had a bunch of insights and rules about VC investing and was often seen as comparable to Charlie Munger in his wisdom. One rule of Valentine especially sticks in my mind. He used to say he wanted to see three things in a promising VC venture. First, a monster market, not medium, huge. Then, a product with an unfair advantage. Third, and finally, management with a plan to use the second to dominate the first. Did you ever invest in a startup on the first round? Probably not, because first, you never get to see the first round. Second, you probably don't have the millions required to be shown it. At most, you would see the second or third rounds, which are, of course, much more expensive. But how would you like to get in on the third round or fourth round with first stage price? Every now and then you can. When a tech product of a public company took longer than anticipated to catch fire, but suddenly it does, yet the stock price doesn't yet reflect it. I call it public venture capital. Why venture capital? First, because you are gambling on the product being successful. It may not be, but second, because often the stock is very illiquid, so you can accumulate it slowly, but you will not be able to sell it if you are wrong, just like private VC. You therefore must do VC level sleuthing and due diligence, and yet be ready to have your money tied up for years before the stock becomes a mega multi-bagger, or maybe a zero. That too is possible. I had mentioned three such companies in the past. Today, I'd like to mention one more. It arguably has Don Valentine's three requirements: a huge market, a product with unfair advantage, maybe, and management with a plan to use it. First, the market, and for this, I need to tell you a short story. In the early 2000s, the Israeli company Medinol invented the stent. A stent is a sort of metal sleeve mesh inserted into clogged veins or arteries of heart attack victims to keep the blood vessels open. It saves lives. The market for such devices was huge even then, $1.4 billion per year, and that was 20 years ago. Medinol cut a deal with Boston Scientific, BSX symbol, a US medical product company that had production and marketing muscle to help make the stent a big success. Medinol made the stent, and BSX produced a balloon to help insert it. It also bought 22% of Medinol. The stent soon became a big success. Then things went sideways. Why? BSX built a factory to duplicate the production to hedge against Medinol possible production problems, but was forbidden to produce it itself. But on the sly, BSX decided to produce stent too and sell them. In other words, it allegedly tried to steal Medinol's business. BSX management figured that Medinol would do nothing because legal expenses would be too high. Well, BSX figured wrong. Medinol's CEO, Kobi Richter, was a former fighter pilot in the Israeli Air Force. A nice guy, until you messed with him. Then he reverted to dogfight mode. He took BSX to court and refused to settle. On the side, BSX shareholders sued BSX management and directors personally for engaging in criminal acts. So after a few years, BSX folded. It paid Medinol more than $400 million in damages, and BSX president and board had to leave. Now, why am I mentioning all this? Because it proves that the market for stent is huge. At the time, it was $1.4 billion a year, but today it is more. How much more? A lot more. Global Market Insights, a medical market research firm, says the stent market today is $9.4 billion worldwide, growing at 4.7% per annum, and should reach $14 billion in a few years. In other words, huge. So again, why should all this matter to you? Because there's another Israeli company that has patented an improved stent. So improved that it may get a big bite of this multi-billion-dollar market. Which company is that? The company is in InspireMed, symbol NSPR, It is a startup that had been in trouble for almost a decade and kept raising money even as its stock price sank. However, it just may be coming out of trouble, which, in my opinion, may turn it into a public VC company. I said may, because all the R&D and testing might have hit on the right product, or it may not. The new product is called a micronet, a biostable mesh woven from a single strand of 20 micrometer polyethylene, which is called terephthalate, PET, a kind of plastic already used medically. The micronet stent is designed to trap and seal thrombus, that's blood clots, and plaque, preventing embolism, that's bubble on the veins wall. The micronet is now undergoing FDA testing, and responses from heart doctors have been, well, heartening. So again and finally, why do I mention it? For 3 reasons. First, NSPR insiders are voting with their wallets. The stock came up in one of my periodic screens for cluster insider buys, several insiders buying together. Second, the stock shows extreme cheapness and value. The enterprise value, this market cap, minus that net of cash, is $20 million, lower than the last 3 years' spending on R&D of $27 million. In other words, the company is selling at less than what it costed to develop the product. This makes the company into what I call public VC. And by the way, market cap is $60 million, yet enterprise value is barely $20 million because the company has so much cash on hand. In other words, it may not need more money. And what's the third reason? That's the market of NSPR aiming at is the same market that BSX tried to allegedly steal 10 years ago from Medinol. It was $1.4 billion a year then, it is $9 billion now, and is going to $14 billion in a few years. That's Don Valentine's first criterion of a monster market. Now mind, this huge market is not exactly empty. There are about 20 companies serving it already. Or can Inspire get a piece of it? That's up to you to find out. Find out how? You got it. Sleuth it out. Of course, this would require some work, but the big prize may be worth a few days or week of sleuthing, no? Yet again, for the last time, keep in mind that the stock is very liquid, which is why I call it public VC deal. What's the upside? Who knows? If the R&D is successful, the company will be worth many, many times its R&D spending. See Meta, for example. It was selling for very low multiple of R&D, and the stock became a 5-bagger in 2 years and still going strong. Of course, NSPR can also go to zero. So what will it be? Hero or zero? This you'll have to sleuth for yourself. Sleuth to? Sleuth how? Talk to heart doctors whom you or your family doctor know and make up your own mind. Check with former colleagues of the executives. What do they think of them? What else? Buy my books, The Sleuth Investor and The Advanced Sleuth Investor. Read them and see the food method for yourself. Then do it. Yes, it's time consuming, but as I said several times before, multi-baggers are not for lazy bones. If you do it right, it pays big. And as important, it may also help you prevent making big mistakes. That's all for today. Please let me know what you think of it. Subscribe to the channel, then forward it to all your friends and followers so they subscribe too. And buy my books. And if you like them, give them good reviews on Amazon. I'll see you next time. And meantime, thank you very much for watching.